times. Good evening, good afternoon, good morning, wherever you are watching from. If you are new viewers, I welcome you to Institute, Blessed Institute. And if you are returning viewers, thank you for joining our channel. If you have not subscribed to this channel now, I'm imploring you and I'm begging you that you try to subscribe. Thank you. So the last class, I was able to solve a question on general purpose financial statement GPFS, and we're asked to solve statement of profit or loss, another comprehensive income, statement of changes in equity, statement of financial position. By the special grace of God, we have completed solving statement of profit or loss, another comprehensive income. So today we will continue with statement of changes in equity. Statement of changes in equity, balance between a balance BD, balance BD. So our ordinary share, what's our balance BD for ordinary share, retained earning? So let's just pick everything once and for all. Ordinary share, okay, balance BD for retained earning, that is the balance we have in our trial balance. Ordinary share of 1 naira each, that is 100,000. Retained earning, that is 30,000. Revaluation surplus, that is furniture, that is 8,000. So okay, let me try to keep three. Let me put my measurement, and we are keeping 30. That is it. In what? In thousand. Prior year adjustment. ERI. Prior year adjustment. So that is, if you notice the opening statement to calculate, okay, the opening inventory we calculated here. We're told that this side we have the what? We have the cost to be 16, and then we have what? We have lower of fair value less cost to sales to be 13,515. So we minus it, we separate it from each other. Whatever answer we get is our prior year adjustment. That will be 16,000. That is the cost minus lower of cost and net realizable value. You understand this one now? If you cannot actually remember, you can revisit the video I uploaded earlier. Do we get? So minus 13,550. That is going to give us 2,415. That's 110 in 2,415. 2,415. So we are subtracting it. We are subtracting it from retained earning. Do we get? We are subtracting. That is it. I put it in bracket. We are subtracting it. All right. So we move to our restated balance. That is the addition of the two above. Restated balance for this one is what? Sorry. Restated balance for this one is 5,515. Then, having done that, we bring our what? We bring our profit for the year in. Profit for the year. So let's check our profit for the year. What's our profit for the year here? Profit before tax is 562,500. If after we have paid tax of 165,000, let's subtract it from each other. If we subtract 165 from 562, we should have 165, 562, 165. Then come here. Our profit for the year still under what? Still under our profit for the year will be what? Our profit for the year will be 397,000. Are we together? So I haven't done that. If we check out, we have our dividend, which is 15,000. Still under retained earning. This one is 397. Our dividend is 15,000, and we are subtracting dividend from whatever total we have, right? Actually, let me just put it in bracket. The minus that is bringing there is because I put in bracket. So then we add that three together. It gives us what? We had it together like that. Do you get? It now gives us 409,000. Excuse me, 409,000. This should be the what? This should be our total. So if we add this one together, this one will give us 100,000. 100,000. This one will give us C8,000, because we don't have anything that should be added. So our dividend is supposed to come here as well. So our dividend here, we have 15,000 here. So we are subtracting it also. So if we subtract it, we put it in bracket. If we subtract it, we then have what? 517,000. So that is our what? This is our statement of changes in equity. So let us just move straight to statement of. Let's move to statement of financial position. Statement of financial position. All right. So as we all know, we have our money measurement here. Let's measure it with 1,000. Then we have our assets. So we have our non-current assets. Our non-current assets. So bring it here. Okay. These are your PPE schedule. Movement in PPE. As you can see, all our PPE, all our assets, non-current assets has been calculated together, and then this is the cost. This is the depreciation of those assets, and this is the impairment loss as calculated above before. So you can check those calculations I've done before, just to verify all these figures that I brought here. And the reason why this one is showing minus because I put it in the bracket. Then this is the carrying amount. So our PP now is 689,650. 689,650. 689,650. So we come here, see that our PPE, property, plant and equipment, 689,650. 9,650. Haven't done that. We move to the next item. Next item, which is intangible asset. Intangible asset. We have goodwill in our question. We have goodwill in our question. So we have goodwill of 45,000. Goodwill of 45,000. Come here. We input 45,000. Right? So if we subtract this from we are not subtracting it though, we are adding it. $45,000. All right, we move to current assets. Okay, let me just add these two together first. The 689 plus this will give us 734, 650. Then we move to current assets. Our current assets, we have inventory at close, which is what? Which is the lower of what? Lower of cost and net realizable value. If you check one of the additional information, we were told that yes, additional information 5, the allowance of the receivable are no longer required. The assigned 10% loan note interest was paid on 30th June 2014, and this has not been accounted for. The fair value of goods is 40,000 at the end. If it is 40 million, rather 40 million at the end, 40 million at the end, as you can see in additional information 4. So let us go and check the closing inventory in our trial balance, or let us go and check the cost. Okay, inventory at 30th June 2014 amounted to 9 million. Are you getting me? Inventory, that is additional information 2. Inventory on 30th June 2014 amounted to 9 million, and we're also told that the fair value of that inventory at the end of the period is 40 million. So which one is the lower? So that was what we actually did when we were calculating our statement of comprehensive income. 9 million. So sorry, suppose inventories, we have 9 million. Okay, after inventory, what else do we have? We have inventories, we have trade receivable, we have cash and cash equivalent. We have cash and cash equivalent, we have receivables. What are receivables? Total receivables and payable. So total receivable is what? Is 48,000. Don't forget the rule for trial balance: debit, asset and expenses, credit, income and liability. So receivable is an asset, while payable is a liability. We have 48 million. We will say receivable, 48 million. Haven't done that. This is our cash. Bank balance, we have 20,900, and we're told that they pay loan 10% on loan. 10% on loan and that's not been accounted for. So it will now be what? It will now be our 20,900 minus 10,000. That is interest on loan. Okay. 20,900 minus 10,000. So that will give us 10,900. 10,900. All right. We have other asset, which is prepaid expenses. That salary we prepaid. Prepaid expenses. That is salary. Can You can check the additional information. We have 10,000 naira. 10,000 naira. All right. If we add the two together with that of, if we add everything together, we have 812,000. 812,550. That is what we call our total asset. Total asset. Total asset. Then we move to our current equity and liability. Equity and liability. So our equity, just as we have calculated it in our load to account, we have OS in our statement of change in equity. Okay, let's just statement of change in equity that we have all this 100,000, 400,000, 409,800, 5 and 6. So we bring everything there. We have ordinary share, we have retained earnings, we have revaluation surplus, OSC, ordinary share capital, retained earnings, and revaluation surplus. So our OSC is 100 million. Our retained earnings 409, and then our revaluation, that is 8. Do we get? So if we add everything together, we get 517. Addition of the three give us 517,000. Then we move to our liabilities. Then under our liabilities, we have payable. Okay, we have non-current liability. Let us split it. Non-current liabilities. Under non-current liabilities, we have the loan, the borrowed, and we already told that one is what? That one is 100,000. You remember now, we charge 10% on it the other time. This 10% that represent our that we remove here. You see here, this 100,000, this 10,000 naira we remove is the interest on loan. So the amount of that loan itself is 100 million rather. All right. So after loan, what else do we have? We have current liability like that. Current liabilities. Under that we have payable. I think that should be 30,000. So 165,000. It's inside the additional information. 165,000. So if we add everything together with the one we have here is 517, we are going to have 812. 515. This one is 409. Sorry, this one is 409. 515. 812. Do we get? So we have come to the end of that. Thank you.